Welcome to the weekly wrap-up where we take a look at what economic events were moving and shaking the markets this week. Victoria Clarke, economist at Investec, joins me on the line now. Victoria, what do you think were the most important data releases impacting the markets this week?
Well, markets are pretty nervous about central banks, particularly the Fed reining in their exceptional monetary support and tapering, in the case of the Fed, of its QE3 program. So in this respect, I would say the US non-manufacturing ISM has shaped sentiment pretty significantly, with a soft reading actually helping to lift markets and assure that tapering may not come about too quickly and too aggressively. So the sub-50 ISM reading, which was actually the lowest since June 2009, raised expectations of the soft QE and that continuing. But of course, the other big release of this week will be the payrolls report, which is due later today, and I think that will also be pretty significant for Fed QE3 expectations.
And what did you think of the US ISM manufacturing figures for May released on Monday?
Well, manufacturing in the US is only about 12% of US GDP, but actually it's been the single best short-term leading indicator, the ISM, for the manufacturing sector of overall US growth since it began in about 1948. So industrial activity does matter. It matters because it drives the service sector. It matters because those employed in the industrial sector for the service sector have a knock-on impact on the economy, and it shapes sentiment more broadly. So it's pretty worrying, the disappointing reading that we had. Having said that, I should say that from here we would expect to see the ISM picking up. Certainly the indicators on demand from China, such as the official PMI's import index earlier in the week, points to things shaping up a bit better. So in terms of the long-term outlook, we're a bit more optimistic, but we are worried by that ISM number earlier in the week.
On Tuesday, the RBA kept interest rates on hold at 2.75%. Do you think this was a good move, and how do you expect markets and investors to react going forward?
Yeah, it seems like a sensible move. They did ease policy the previous month, so it was expected that they would be in a policy pause mode and sit back and effectively look at what the outlook is for the economy and for prices as well. They did indicate in their assessment that there was space within the inflation outlook to provide some more easing if they needed to, and we think it's quite possible that going forward we might see this used, and effectively they might bring rates lower even more, particularly so that they seem to be worried about the mining sector in the US and the fiscal squeeze. In terms of how markets may take that, well, I'd say we'd see a pretty positive reaction if we see the RBA being proactive again, because certainly there are some question marks there now about the Australian economic outlook and how the economy will perform over the year ahead. So good news that the RBA remains on the front foot.
And on Wednesday we received Australian GDP figures, this quarter standing at 0.6% and year-on-year declined 2.5% from 3.2%. Why do you think we have seen a halt in growth in this quarter, and isn't the decline to 2.5% year-on-year worrying to markets?
Well, yes, growth over the quarter on a seasonally adjusted basis was steady at plus 0.6, same as the previous quarter. But also, yes, the year-on-year pace of growth has come down. Not a huge shock to markets, a little bit disappointing. But the strength of the Aussie has been weighing on the manufacturing sector there. A little bit of that has come off in recent weeks, but it does look as though the big issue for the Aussie economy is the mining boom, which seems to be finally plateauing and therefore kind of hitting exports. Whilst not a big surprise, it's going to remain a concern, certainly for investors over the months ahead, and they will be looking for some direction further along as to where the main driver of growth will come from. So, related to the prior question, the RBA and their easier policy stance may be one source of growth momentum, at least as a temporary uplift, and we'll look for that over the months ahead.
And what did you think of the BOE rate decision held at 0.5% yesterday, and what signal does this send to markets about the UK's assumed economic recovery?
Well, any downward moves in the Bank of England's bank rate were effectively off the cards. They've not really been talking about that seriously now, ever since it reached its record low of 0.5%. The debate is about whether they can ease policy via their quantitative easing programme, which is at $375 billion at the moment. The current governor had his last meeting, and yesterday's decision of on hold was no surprise, but we think what we'll see now is when the new governor comes in, Mark Carney, who's coming across from the Bank of Canada, he will want to do more. to try and provide a bit more of an uplift to growth, to try and find that so-called escape velocity. So in our view, more stimulus will be coming. It's just a matter of time, and that, I'm sure, for a recovery which has been pretty lacklustre, will be a very welcome boost, but probably not deliver a step change in growth.
Victoria, the data doesn't quite end there, as we will receive the US non-farm payrolls data and unemployment for May in a matter of hours. What are your forecasts, and how quickly do you think we can expect this data to trigger a move from the Fed on whether they pull back on QE this year?
Yes, as you say, it's a major release today, particularly because it's shaping QE3 expectations. The surveys so far this week have not been particularly positive as an indicator of what we'll get for the non-farm payroll gain. The ADP survey, which is one of the closest related, suggests, according to our models, that we should see a non-farm payroll gain of close to 125,000, which would disappoint against the market. It's looking for something more like 165,000. Not a huge train smash, but it may be soft enough to keep the Fed continuing with QE3 for some time longer, particularly if unemployment remains steady at 7.5%, as we think it will. So in terms of the Fed's next move, we see that most likely coming at its September meeting, where we think we'll see the first move to taper the amount of QE3 purchases, bring it down from the $85 billion that they're currently buying a month, but we wouldn't see them bringing it down sharply. I suspect it will be a fairly steady tapering, because the US recovery could still be in a fairly steady, modest, but far from strong state at that point.
That's all for now, but join us on Monday for the week ahead to see what events could move the markets next week. I'll now leave you with some quotes from experts we spoke to around the world this week. Have a great weekend, and bye for now.